SoFi Technologies. This is a company that I have been hearing about nonstop. People are saying, Mo, this is getting too cheap to ignore. Okay, let's figure out how we actually need to pay for this thing, because to me, there's not enough data. So what we're going to do, we're going to start looking at their past history. We're going to look at their revenue. We're going to look at their profit. They're absolutely a growing company because they're so young and they're getting involved in so many different things. With that being said now, let's go and look and see what analysts have to say. Let's plug it into Stock Analyzer. Let's look at some trading, and then let's look at options. This might be a great company to sell options on because there's so much volatility. You might get great premiums. First things first, this thing in 2021 was up here at $25 a share. When they first IPO'd, it was the greatest thing since sliced bread. And apparently today it's not, because it's sitting at $6. So it was a heck of a run up. This year it's down way more than 50%. It hit a peak of about $16, and today you can see we're sitting at $6. So let's look at their growth. I'm looking at the annual financials here. So in 2018, they did about $269.5 million in revenue, grew through the pandemic. They actually had a big boom between 2020 and 2021. Not surprising. They almost did $1 billion worth of revenue. So the company is growing. That's not surprising in any way whatsoever. Net income, still not making money, which is, again, not totally surprising for such a young company. But what does kind of worry me, they did a $250 million loss, $240 million loss, $225 million loss. And then what were they doing here? What were they spending on to have almost half of $1 billion loss? That is something that we might need to dig into a little bit. Shares outstanding. Their dilution is not as much as I expected. Between 2018 and 2021, there was not any share dilution. They diluted you a little bit as a shareholder. In 2021, I'm sorry, I said 2018 to 2020. In 2021, they diluted you a little bit. It's not totally surprising, and I actually thought it would be much, much worse. Now, do they have cash flow? No. They do not have any cash flow right now. It is negative all the way through. Are they doing any acquisitions? They did a small $32.5 million acquisition in 2020. It's not anything massive. Let's go and look at their debt situation, because when you're looking at a company like this, what exactly are they spending on? Total assets of $9.18 billion. Total liabilities of $4.5 billion. Not bad. Okay. So let's go over to the analyst estimates, because this is really all I have to go off of right here. So when I look at this, look at their earnings per share. It's all over the map. It's truly all over the map. In 2022, they're expected to do a 186% gain, a 5,800% gain in 2024, and then they're doing negative earnings per share into the future. So there's something wonky going on here. I don't necessarily understand it, but this is the kind of thing, if you're interested in this company, go and look at this. See where these guys are coming from, because these numbers are all over the map. See exactly what they're saying and what they're seeing. It's very important to understand that, because you don't have a lot of financial data to go off of. Let's look at their revenue estimates. Not bad, 50% in 22, and going into 2026, you're sitting at 34%. So what I'm going to do in Stock Analyzer tool, I'm going to put in 34% for my high side, just because I don't necessarily know, and I'm going to do a 5-year outlook because I'm going to stay consistent with them. I can't say that I'm going to look at this over a 10-year period. It's just not practical to do so. So let's go and throw in the numbers in a Stock Analyzer. But before I do that, my name is Mo and I'm a value investor. And the reason that I'm saying all these things about being skeptical and speculating on this future is because I am that value investor, and I need to know what exactly I need to pay for something. Just because this is sitting at $6 a share and it was however much it was back in the past doesn't mean that this is even a good price. I might have to pay $3 for this. I might come to a number and say, I cannot, this is too hard for me to figure out. But this stock might have to fall in half again, which may sound crazy to you if you're seeing this for the first time. But I base things off of numbers, and I base things off of qualitative and quantitative issues to tell me how much do I need to pay for a company. So let's look at that right now. Revenue growth. Let me check that. I think they said 34%. So let's go 34% on the high side for this company. And the mid-level, I'm going to do 25%, and I will do 15% on the low end. So what this is telling me, and changes to 5-year estimate, what this is telling me is I need to see, this is going to spit out 6 numbers at the end, and it's going to tell me basically where my starting point is with this company. This company needs to do 15% revenue growth for me to pay X, 34% revenue growth for me to pay X, and that's over the next 5 years. So that is what these numbers I'm putting in mean. Profit margin. Profit margin is going to be hard because they're not making a profit right now. So how am I going to decide what the profit margin is going to be? I think, so they're in the financial area. I think we might have to go to some other bank to see what their profit margins are. So I'm going to come over here I'm just going to quickly let's type in Ally. They do a very similar type of thing with loans. Profit margins there. Okay, let's look at profit margin. We're sitting in the range of 27.5 over 1 year and 21.4% over the last decade. So we'll use those numbers as a basis. SoFi, let's go back to it. Revenue growth, let's go to that 34%. We'll go 25 and 15. I am going to put in here 20%, 23%, and 26%. We're really going to inflate those numbers. Free cash flow, I'm going to put in the same thing because I don't have free cash flow, so I'm going to have to make those assumptions. PE, this is a hot and coming thing. I'm going to put in 14. You know what? I'll give them the benefit of the doubt. I'll go 16, 18, and 20 because the growth is actually, you know what? Let's go 18, 20, and 22 because they are going to be growing very quickly. Same thing for price to free cash flow. And now my return. For my return, because there's so much speculation going on in here, I'm basing things off of other companies right now because there is no history on them. I'm going to put in higher returns here. So I'm going to put in on the low end a 15% return. That means I need to get 15% of a return based on these numbers to want to pay whatever price is going to spit out for this company. Next thing I'm going to put in 17.5, and then I'll put in 20% on the high side. So I need to be rewarded for owning this company. Now let's look. This is probably why a lot of people in our community are asking for it. Based on my assumptions, we are spitting out that we are right at the numbers that we look at. $6.32 on the low side, $16.16 on the high side. Current price is sitting at about $5.97. So what do we do now? Well, let's say $6 is your number, but maybe you want to pay a little bit less for it. Well, to me, this is a great opportunity to come over and do some options. And what we can do is say, hey, we want to sell some puts on this. So selling a put is basically making an agreement with the market that they can place shares in your hand at a lower price for a future date, and you get paid to wait in that time. So what I'm going to do is click on puts up here, and I'm going to go out to, let's call it October 21st. And I'm going to look in the range of, let's say $5 a share. So I'm looking at $5 a share, and I'm going to be paid 17 cents per share. So what this is saying that I'm going to sell a put for $5 on October 21st of 2022, so 10/21. And if SoFi gets anywhere below $5.00 or lower, they are going to take the shares of SoFi and put them in my hand. I am going to have to own them. I'm going to have to buy the shares. If it closes anywhere above $5, so $5.01 or higher, they're not going to put the shares in my hand. I collect my 17 cents per share. The contract expires worthless. I write it again in the future. This is just a great way to generate some income and wait for a stock that maybe you don't necessarily want to pay $6 for it, but you're comfortable paying $5. You could also come over here and trade this bad boy. This is a company that has been really, really abused, as we can see on this long-term chart. For me, now let's take a peek at this. We're below all of our major moving averages right now. We are below all 4 major moving averages, those being 200, 100, 50, and 25. So there is definitely some room to run on the way down. But looking at this chart overall, I think we're probably pretty close to this bottom. I don't necessarily think we're going to drop very far below that $5 level. And if we don't, maybe buy a tracker share on here. That's just buying one share. Buy one share of this company for $5. Here's the literal worst case that happens. I'm sorry, $6. Worst case that happens. This company goes out of business, never exists again, and you lose $6. The best case scenario, we wait for this long-term stochastic to drop down here and then cycle back up. And as it moves through this sweet spot area, the price continues to climb. People get interested in the stock, and hopefully you can go for some crazy run to the top side. But my point in telling you all of this, there's different things that you can do here. You can go at it from a value perspective. You can go at it from an options perspective, and you can go at it from a trading perspective. There's a lot of ways to make money on this company if you're not just wanting to buy it and sit and hold and see what happens in the future. If you are getting involved in a stock like SoFi over a very long period of time, I just briefly scraped the surface of how you can incorporate some type of margin and safety. Paul covered a video right here that you need to watch that really goes over what margin of safety is and how to apply it to your strategy. Go watch it right now. You need to. I'll catch you on the flippity flop.